Hello and welcome to FinTech Impact. I'm your host, Jason Pereira. Today on the show, I have Hans Zandhuis, president of Ally Lending. Ally Lending is the lending division of Ally Bank, which is a long-term player in the online banking space. And with that, here's my interview with Hans. Hans, thanks for taking the time today.
It's Monday morning, Jason. All good.
Okay.
Happy to be here, Jason. Happy to be here.
Yes, what you didn't hear there is we edited out about 3 attempts at getting the introduction right. Yes, it is Monday at 9 a.m. And I had insomnia last night. Okay, so Hans Zandhuis of Ally Lending. Tell us about Ally Lending.
Well, Jason, happy to do it. And good morning. I think so. Ally Lending is the point of sale lending arm of Ally Financial and Ally Bank. We have been around for now 6 years. We started as Credit Services Corp, but we were lending in the medical environment only. Ally acquired us in October of 2019, and we have continued to grow. Since then, we've grown into multiple markets, home improvement and retail. And we basically like to be at the point of sale. So if you go to a doctor's office or you go to a retailer, or if you go to home improvement, or if someone from home improvement comes to your house, we are an option for those providers.
Excellent. We're going to talk about the distribution of that and the challenges within, because that is not a small feat. So give me the history. You already gave me kind of the rough history of that this was an acquisition, but give me the history of the company and what led to its foundation and eventual merging with Ally.
Sure. So myself and 2 other founders, Matt McKenna and Clark Burget, started the business in June of 2015. We funded it ourselves, kind of grew the platform, brought on a number of other institutions to kind of be our balance sheet partners, and then grew the business. And when we got to roughly probably about $400 million in originations, we got acquired by Ally in, again, as I mentioned, in October of 2019. At that point, we were only in the medical space. So we would basically, if you were in the doctor's office, the inception of the business was that how do we help consumers pay for healthcare? And as everybody knows, consumer responsibility is growing every year. And as more of that responsibility pushes away from employers and away from insurers to the consumers, how do we help them pay? You've obviously got higher deductibles, more out of pocket. And so we continue to feel that's a huge opportunity to help consumers pay for healthcare. Healthcare is the largest driver of bankruptcy for consumers. And so how do you balance that? And then as we got acquired in 2019, we started looking at other markets, and we moved into home improvement in effectively May of 2020. So when all was right, that was in the middle of the pandemic, and we kind of opened up into that space. And then really beginning of late 2020, early 2021, we piloted in retail markets.
Interesting. So how long did it take you to get to $400 million in total lending?
Took us 3.5 years.
Jeez, I'm curious. When you were just in the medical space, what was the average loan size you were dealing with?
Average loan size was about $4,000. So we were in both elective and non-elective space. And really, so if you needed a new knee and you weren't planning on getting your ACL done and you had $5,000 out of pocket, we would cover up at least up to that. We go up to about $40,000 for the consumer. And so we started there. Or if your kids needed braces, that also tends to be about $4,000. Hearing aids, $2,000 a piece in the States. So all of it kind of evolved around about $4,000 to $5,000 per ticket.
And, how small a loan will you do? Set up to $40,000. What was the typical kind of minimum entry point?
For us, we generally don't go under $750 at the moment. We generally think there's we're an installment loan only. We do not do line of credit. So in that installment loan, when you kind of look at what's your minimum that you would really, and we can do a 6-month or 3-month promotions, and we go up to really 84 months in length. And so just want to find that balance where the ticket, you don't want a ticket obviously sitting at $10 a month for somebody.
Yeah. And I was asking those questions for a very particular reason. And I was trying to, let's address the challenge, right? When it comes to lending from traditional banks, the reality is we're typically talking much larger numbers than $750, right? We're talking about mortgages on your house. We're talking about personal lines of credit, several thousand. And in that moment in time, when you have that expense that presents itself to you, and if you don't have an available credit facility for you that was negotiated for something else previously, the odds are you're not going to say, okay, I need to get that surgery done. I'll be back in a couple of weeks after I go negotiate a line of credit with my bank. It's a highly inconvenient. And if you're already at a certain level of credit, that might be a very difficult thing to do. So, the need there is very real. I won't say you're definitely not a microtransactions company, but you're definitely one where the numbers aren't really appealing to traditional lenders. Is that about fair to say?
Perhaps. I think what we have seen is consumer behavior is changing. I think consumers are looking to move away a traditional credit card only type transactions. Yes. And that where, all of a sudden you sit, if you have a credit limit of $10,000 and all of a sudden you sit at $9,000 because you've been using it for these little incremental things. And then you don't remember, wait a minute, what did I buy for that $9,000? I think what consumers are really starting to move towards, and I think you'll see that because of if you look overall at the general line of credit continues to grow in 15 to 20% a clip per year, where credit cards been pretty flat to slightly down. And
in fairness, those rates haven't changed much, whereas the line of credit rates have been this long progressive downward slope, right?
That's true. So rates are better for the consumers, one. Two is they can say, this is my loan. I'm going to pay for this loan. It's actually more responsible because I'm going to pay for this loan because this loan was my kid's braces or was my knee. And they like to actually pay that down and kind of connect the payment with what was actually being done.
It's a mental accounting trick. I can see that. It's a behavioral finance concept.
Mentally, right. Yeah, exactly. And so I think that, and the fact that our rates are better rates for consumers, continue to think that's going to be a trend for probably, I would think, the next 5 to 10 years.
Oh, there's a lot of daylight between secured mortgage rates and credit card rates, that's for sure. So there's some room there. And the mental accounting trick is interesting. I can see that, right? Because I don't think anyone gets a credit card bill and doesn't feel a little bit of guilt. Whereas, and maybe 3-4 months down the road, they've disassociated what it was that they were actually spending that money on. Whereas you've actually created, again, a mental accounting trick here, where it's essentially like, that's the loan that was for this very specific purpose, and I'm okay with that. So that makes a lot of sense.
Well, and one thing we also saw was that consumers really like to kind of keep their credit cards for either emergencies, if their dryer goes out or something to that effect, or and for vacations. And so, consumers love their vacation, especially, US loves their vacations. And so they don't want to have no credit facility for them that limits their ability to go on vacation. And so kind of spreading that out into a different facility has proven to be the right call for us. We've had a number of conversations when we looked through, when you look through years like last year, credit card spending was down, credit card debt consolidation was down. The industry overall was up, and we were up 100+%, last year. And because consumers, where we were, people were still spending money on medical, except for 60
renovations.
days.
You were in a good spot for renovations. My goodness.
And then renovations. When that was certainly, we grew the business in renovations, obviously from zero last year to about just under 400 million, which was amazing. We grew that much in 1 year when it took us about 3.5 years to get to the 400 million first time around.
So talk to me about the challenge of distribution, because your specific term that kind of resonated was the point of sale lending. So it's a decision being made at the time of acquisition of whatever it is you're getting, the product or service. That basically means you have to be there at the point of sale. So talk to me how you accomplish that. Yeah,
Jason, I appreciate you mentioning that. We are a B2B2C player. Mm-hmm. And unlike, I think, a lot of other kind of fintech platforms that are out there today that kind of are, I think, a more traditional D2C play, our whole platform and a lot of the kind of value prop that we put together and we've invested in is the B2B2C. So how do we integrate into our providers? And those providers, again, are medical, home improvement, and retailers. How do we integrate into their workflows, into their systems, so that it's not a separate workflow? It actually, they have their own workflow that kind of takes a consumer from A to Z. And how do we fit into that workflow so that it's a simplified process for both the providers and the consumers? And so what we do to then go out and get them is we go out and we literally have sales teams that are out talking to doctors' offices, out talking to home improvement providers, HVAC, roofers, things like that, mostly ones that are out in your home. And then obviously we're just now getting into retail, and where then we are just basically an option for the consumer when they are at, when they're at the decision point of, okay, I need to get a new roof and it's $10,000. How are you going to pay for it? And we're an option. And we've got groups that do 20% of their tickets are point of sale through us. And we've got other groups that 90% of their consumers are actually funded through loans.
So are these companies simply just letting them know to basically visit your website and go through the application process? Or is there anything more embedded than that?
No, we again, great point. I appreciate you saying that. Is we embed into their, through our APIs and their APIs, we embed into their workflow. So if they're using some CRM, whether it's Salesforce or anything that, we can be Epic in some of the healthcare spaces, we integrate into those platforms. And then that way they don't actually have to get out of those platforms and out of that workflow to assist the consumer with payments.
Interesting. So, and it makes a lot of sense. What you're doing is you're trying to create a seamless decision where basically it's like going through a checkout process and having that option at the end. So
what we've found is that yes, you can create yes, you now found out that it's $5,000 and what are you going to go do? Go out to an app or go out to a website to go and get a loan and then come back and there's some interaction and they provide you some number. I just find that a very kludgy process and not simplified for the consumer or the provider for that matter. So when I think of our value prop is how do we integrate in the consumer? So when I'm looking at where am I investing in the technology, we're investing in our APIs, we're investing in how we integrate into multiple platforms across multiple verticals. And then what are packages that we think are important to understand for us to understand our consumers and our providers for that matter. So we'll work around creating marketing campaigns to both the consumers and the providers. We will look to develop the better understanding of how we're making decisions around that. So when we start talking about where we're investing as a technology, to me, it's all around the B2B, predominantly around the B2B, but obviously the experience for the consumer as well, and obviously pricing for consumers.
Yeah, I mean, it really does need to be as seamless as the cash or credit question, right? At the end of the day, if you say, okay, cash credit, or by the way, go through these other 5 steps on your phone and then come back to me and show me the authentication or it'll email me with this code. Again, broken experience. No one wants that. At the end of the day, you need to remove the frictions to all of this to make it a viable option. So it makes a lot of sense that you've done that.
I remember when I used to run the debit card business for B of A. And at that point, we were pushing PIN and really wanted people to pick up the chip and leverage the chip. No one wanted to leverage a chip except in Europe. And then it wasn't really until the pandemic that the chip really has taken off. And because it's a more simple process. It's a more simple process. So you just tap and you go. It's very similar in the B2B environment, right? How do you make that process so seamless and so simple so that the consumer just adds, and sometimes you feed from the provider basically system into ours so that it simplifies, so the consumers then only need to add 1 or 2 or 3 incremental data sets, and then you're approved and you sign and you moved on.
Yeah. Living in a country that got the chip way after Europe, but way before the Americans, I used to still wonder every time I went down there, please tell me why I am authenticating with a squiggle of ink. This makes no sense to me. But in fairness, correct me if I'm wrong, I think it was about 3 years ago or something that I think the credit card companies changed their terms of service that fraud was the responsibility of the weakest point in the chain. So everybody went around and updated their machines to basically support touchless pay. And that kind of helped create the infrastructure to support everything. So fear of lawsuit or fear of being stuck with the fraud is a great motivator, isn't it?
Money is a motivator, without a doubt.
Well, it's one of, I mean, don't get me wrong. It's one of those things where your start point determines your trajectory. And, there was a lot of convenience in just swiping. So adding another step was not necessarily seen as beneficial, but someone who pays for almost everything with his watch I much prefer the tap experience. So
I remember when I was running that business, I said, okay, I'm no longer going to use cash. I just want to see what kind of migration I could do to a debit card. And in fact, actually, I basically got 100% to a card. I remember my kids always were yelling at me, Dad, you have $5. I never carried cash. Still don't carry cash. And even more so now, and that I went really certainly to card at that point. But now, to your point, I'm a big fan of just simply using your phone, using any of the options that your phone offers you, or your card, I think does make it simple. And that kind of gets wrapped back to us. If you kind of go back and you're going through a whole process, again, I'll use the dentist and your kids' braces as an example. You got to keep it simple. You kind of get to the point where, okay, Johnny needs $5,000 worth of braces. How are you going to pay? And they're saying, here are our options. And you can press, this feeds here, hit these 3 or 4 fields, and here are your options. E-sign the documents and you go. Keep it simple. If it ends up being this, wait a minute, let's go create this paper-based process, sign all these things offline. They're going to input it in or something to that effect. You will, A, it's a terrible experience for the consumers. And then B, I think your pull through on that's going to be really low.
I largely agree. Again, any point of friction is a point where people jump off. That's what it comes down to, right? It is what it is. So talk to me about the initial feedback you garnered from the vendors you went to, specifically we'll start off with the medical industry and then we'll move over to renovations. But did they look at this? Were they skeptical? Like when they first saw it, what was the reticence that you encountered? And then when they adopted it, what was the feedback from there?
What I think we found was our providers really thought that our process was considerably simpler. If you look at kind of some of our competitors out in the market, a lot of them tend to be people that have been in the space for 15, 20 years. I think their process really is a little more, I'll call it kludgy, just not as streamlined. And so I think what we found was because it was so simple, in general, if you think about our providers, and let's start to medical, a lot of the medical front end employee base, they have turnover of 1.5 to 2 a year. So it has to be simple for that group to basically be able to pick it up and actually then integrate it into their sales cycle. And so our training can go 45 minutes to an hour, but generally people are done in 20 to 30 minutes because it's just, they get a sense. You kind of walk through apps, you're going to walk through disclosures, you're going to walk through signing the documents. It's pretty simple. We think it's an extremely simple process. And so as you go through that, we found that was probably was the most important attribute. The second most important attribute was getting approvals. Obviously, you don't want to get how do we get your consumer, if that consumer goes through and then gets declined, that's a terrible experience. And so we worked with our partners to try to figure out, okay, we risk-based price, how do we help them kind of get to a point where they can get as many approvals, and the consumer can get as many approvals that they're interested in. And I would say those were the two kind of right out of the box that we really kind of was our guiding light. And then I realized, okay, well, how do we really start integrating into that simplified process into their workflow? And that's when we really started, probably in 2017, we really started investing. We were already invested in APIs, but I think we invested heavily in APIs at that point to start becoming simpler and simpler. And honestly, when I think of Stripe actually really helped me learn about, wow, look at what they did around their API strategy. And that actually helped give me a little bit of a path that said we really wanted to be the Stripe, at that point, the Stripe of lending, and create these APIs that are completely simplified so that we can integrate into all these different workflows. And that's been one of our kind of larger drivers in my view.
Now, Stripe is remarkable. Copy, paste a couple lines of code and suddenly you're ready to go. So let's go back and touch upon something you mentioned briefly, and that's kind of your approval process, specifically as it has to do with underwriting. So you mentioned risk-based pricing, which just means, hey, you're going to charge more for people who are higher risk and therefore offsets the risk of that. Tell me about the challenges you encountered in developing a kind of point of sale underwriting model and how you basically get people to yes at the right number as fast as possible.
So I would say first and foremost, it was actually the underwriting of the provider, which really, I think, started our journey of risk and understanding risk. If you sign up a provider that is not a real provider, and then it's kind of they're kind of running fake consumers through your portal, that's where you're going to get your biggest potential risk. And so, you got to first make sure that who you're doing business with is a legitimate organization and is providing services. That's probably, in my view, 80% of the battle. Get that right and do that in a way that's automated so that you're not doing, we started out doing manual underwriting, obviously, and migrated that to fully automated underwriting up front. That probably reduced of the risk and fraud that we had. That reduced probably 80+%. Then you went to consumer. At that point, then you're saying, okay, the consumer is going to the doctor's office and their kids are getting braces or they are getting a new knee. So there's a lot of kind of like what I would say is natural kind of KYC, know your customer activities that are happening between the doctor and the patient in that process. And how do we leverage that in us understanding who that consumer is? And then you added, obviously, we have over 24, 25 different attributes that we pull in. FICO is one of the 24, but we've added alternative data sets as well to basically help maximize our understanding of the consumer and the risk that we're taking on through an approval.
How's that worked out for you thus far? I mean, I've seen all kinds of even academically supported reports where basically these risk ratings are being developed to such a level of proficiency that they're, compared to the FICO score, they're far superior, lending to people who would never otherwise qualify at rates that FICO would predict 2 to 3x the non-compliance rate. And not being the case. So, how's your experience?
And I think it depends on the product that you offer, right? I think if you look at some of the buy now, pay later options that are out in the space today, from the groups, and we know these groups very well, they tend to have 60+% of their consumer base is low FICO to no FICO. And whether they're new consumers into the commerce environment or they just haven't kind of taken the time to build credit, I think and most of those guys leverage, I think, phone data. I know they leverage phone data at a pretty high clip. We like to consider that data. It's a part of our process. But I think, and those groups tend to, that product is it's a 2-month product, 3 payments, 4 payments, 3 payments after you do the down payment. And I think that it'll be interesting to see how that group performs here over the next kind of 18 to 24 months. What I'd like to think is we've kind of found the balance between FICO only, alternative data, and the combination of them. And we would not be making, I'm not giving 60% approvals to no score, but I basically feel like we're in between and we take all the data sets and we may, and then also, so it depends on also the ticket. So if you're putting up an approval for a ticket that's for $250, which is $200, $300 is the average ticket for a buy now, pay later platform versus ours, which is really our average tickets of $4,000. Actually, it's now trending closer to $5,000. There's a difference in obviously what we're going to kind of approve and how we're going to go to market.
So talk to me about the expansion from medical. Why was renovations the next logical place to go? What else did you consider? What was in your slow taking over of different aspects of the universe? Where do you want to attack next?
Well, it really comes down to when you look at consumers and where they're spending their money, there's of the 1.3 trillion that's spent, right? You basically have retail is number one and your largest. Then you have home improvement, then medical, and then you have kind of travel sits at like 1-2%. Mm-hmm. So those are the 3 buckets where consumers are spending their dollars overall. Again, whether it's point of sale or credit card or whatnot. So we basically broke this down, started in medical, and then what was next. For me, again, it goes back to when you look at our workflow and how we fit very well, and our product set, we fit very well in the home improvement space. That was the kind of natural next step. Higher ticket prices. Most of these are home owners. So it was a natural step for us. Then the third step, it was retail. And we actually partnered with Sezzle, who's a buy now, pay later provider today, as you know, and growing great partner. And we felt the combination of our product and our longer term products with their shorter term products was a kind of a nice step and a nice way to get into retail, and then provide, again, as broad of an approval as we can for those retailers that we're partnering with Sezzle.
It makes a lot of sense. I mean, if those are the four areas, you went for the two largest ticket items that there were with the fewest number of transactions, right? I mean, that's what it comes down to. Whereas, the retail stuff, like the Sezzles and the Afterpays of the world, I'm seeing this stuff come up on like $50 purchases. That's a heck of a lot of underwriting for a heck of tiny loans, a lot of tiny loans. And then although I'm very interested in the concept of travel financing, that should be, that might be the next greenfield people tackle. That'll be amusing.
It'll be interesting. There's a lot of fraud there, right? And so you've got to be really smart about how do you tackle that. And I think one of the things that I had a phone call basically from an investor-based group last week, and they were talking about, well, you're starting to see delinquencies tick up in the some of the buy now, pay later platforms. And what do you think about that? I actually have not seen that data yet, but that's what they were talking to. And I just said, well, we kind of talk through again our approvals and where we are and the decisions we make versus the differences that on the decisions that they're making. And so, we'll see. But to your point, they're lower ticket. The average is about $200. But again, that makes it okay. You take $50 out of your paycheck for 4 payments, $50 seems simple enough. But if you are living check to check, that's still $50, and that's $100 out of the month. So we'll see how that plays here in the short term.
Yeah, it's a different challenge. Like I said, I mean, to me, especially given the way you entered the market, and again, the initial vertical that you went into, the secondary one, when you broke it down in terms of spending, just makes so much sense in comparison. Let someone else worry about microtransactions. You worry about the bigger one ticket ones. That it's not only that. I think, frankly, there's a big difference between wanting to finance that iPhone purchase versus, oh boy, I need to replace my bathroom, or oh my goodness, I need to have this surgery, right? Like those are different.
Well, no, I think and I'm not rushing to jump into that kind of that e-commerce lower ticket environment. I'd like where we are. I think the advantages that we have, the investments that we've made over the last 5 years, specifically again around that whole value prop of a B2B2C, I think is really what's going to continue to lead us. And we'll watch how the kind of smaller ticket e-commerce transaction flow goes over the coming years here.
So before we wrap up, there's 3 questions I ask everybody on a positive note. The first one is, if you had one wish for something you could change in your company or in the industry as a whole, what would it be?
More dev capacity.
Oh my God. Yeah, there you go. That's one way of saying it.
I mean, you can't get enough developers and we can't move fast enough. And what's exciting, I've said this before, is I really believe I've been in payments now for at least 15, probably 17 years. And I love what I see. I think it's just been such a great amount of movement during that period. But I think we're probably only in inning 2. I think we've got a long way to go of what's going to happen within payments. And it's just an exciting place to kind of stake your claim. And that's going to be a fun industry to be a part of for the next 25 years.
I have no doubt. The debt capacity one, I mean, more often than not, the answer is similar. It's people. And it's, getting the right people. And some of the stories I hear now of people, of young people finishing like coding boot camps and getting poached to move to the Valley. I'm just like, what is going on? There's this
$75,000 kids are, people coming out of high school making $75,000, and which is amazing. Like, good for them. And
good for them, but
see where that goes long term.
Well, I will also say, we all know that you can have 10 moderately okay coders that will accomplish the same work as one really talented one, right? So it's I'm lucky enough to know a handful of very talented ones who get a lot done. And my goodness, like the delta on what I see them produce versus others in teams, it's night and day. So yeah, it's good for them, but I also worry about the general quality of some of the stuff coming out. But just because we're trying to fill the demand curve on this one, is what it is. Second question for you. What's been the biggest challenge? Or maybe it's the same question. What's been the biggest challenge in getting to where you are today?
We started the business, frankly, with our own money, and we funded it. We funded the loans. We funded the investment on the platform. It used to be call it in 2017, 18, and 19, this wasn't as, especially as a balance sheet lender, which I was always a believer in. You have to have some of the risk or else you don't really understand the credit decisions you're making. And so was capital. So that was the other piece that was tough when we were on our own. Obviously no longer an issue. I would say since kind of the acquisition, I would say that while the market has the speed of change in the space is incredible. And it just feels like in the last 2 years that we were clipping along at probably a good 50, 60 mile per hour rate. And now we're sitting at 100. Everyone is running. And so that's great. It offers a ton of opportunity, but you got to pick up the pace.
And lastly, what excites you the most about what it is you're working on today and keeps you getting up in the morning to fight the good fight?
Yeah, I love where we sit. I love being the B2B player. I love building a value prop around B2B to C. And I think that's going to be our real strong differentiator over the next, call it 5 to 10 years. That's going to give us a real long run, could kind of take over. My goal is in the markets that we play, I used to be more of a Jack Welch kind of guy, be a top 3 player.
Yep.
If you can't be a top 3 player, don't be in the space.
Yep. No, it's true. Disproportionate profits aggregate to the top. So it is what it is. Hans, thank you so much for taking time today. Sincerely appreciate this. And thanks for telling your story.
No, nice to meet you, Jason. Look forward to staying connected.
So that was today's episode of FinTech Impact. I hope you enjoyed that. And if you're in the U.S. looking to finance either medical or renovations, take a good look at what Ally's offering, because I think it's, frankly, it's a nice, convenient option other than your traditional ones. As always, if you enjoyed this podcast, please leave a review on Apple Podcasts, Stitcher, SoundCloud, Spotify, or whatever it is your podcast. Until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at jasonpereira.ca.